Hey, Facebook. Thank you so much for tuning in. Welcome to Commission Boot Camp. Happy Tuesday. Today I am joined again by the beautiful Sarah Jackson. She is our lender here at our community. She's a wealth of knowledge. Yesterday we had about 20 solid minutes going over introduction to loans. So if you guys missed that one yesterday, feel free to go back and watch. Today we're going to be talking about FHA, USDA loans, credit options, bankruptcies and foreclosures. So grab a note, grab a notepad, and be ready to take some really good notes, you guys. And of course, feel free to jump in and ask some questions. Miss Sarah, I'm going to hand this off to you, and I'm going to grab my notepad and start taking some notes.
Please do. Thank you guys for joining us today. We got a little cut off yesterday, but I wanted to kind of continue with our credit where we spent income. So credit was the next topic on our list. So credit is something that when we're looking at a person's credit report, we look at certain things. And the most important thing about credit is ability, stability, and willingness to repay. And basically what it is, we want to see how long a person has had credit, how well they pay their credit, their utilization of their accounts, and how their credit, we look at it as how well they've managed their accounts, how long they've been on the road. But we also look at things like BK. Is there BK on your credit? Is there foreclosures? Is there child support? Maybe there's loan modifications and short sales or taxes or judgments. So those are all things in our credit report. It really tells a story about an individual. And depending on these things that maybe show up is going to depend on how we can lend. So I do have a PowerPoint presentation, and basically on my PowerPoint it talks about the seasoning. And what seasoning is a length of time. So when you hear a mortgage lender refer to seasoning, it means how long the time is, the duration time. So for a BK on certain entities such as an FHA, if a person has a BK, they have to wait 2 years to purchase a home from discharge date, not from filing date. That's very important. So anytime we look at the credit report under public records, we will see a BK, and we have to make sure that BK discharge date is reflective. We usually will request pay documentation. And so BKs are 2 years unless you have a Chapter 13. That's typically on Chapter 7 or 11. But if you're a 13, you can actually buy a home and still be in the middle of a Chapter 13 bankruptcy as long as two things take place. You have 12-month payment history, no late. You've paid all the agreed payments on time. And most importantly, you have permission from a court. I've had people go under contract or in a Chapter 13 bankruptcy, and they've missed the most important piece where is the permission from the courts. And the reason being is because you needed the courts to facilitate or help you get back on track. So in order to get it underneath contract by a car, by a home, you have to have permission. Okay? VA is the same, it's 2 years. Conventional is a little bit more strict. It's 4 years. And then on our foreclosures or foreclosures are pretty much treated the same. So the seasoning or the length of time that you have to have in FHA would be years. Same with the VA, 3 years. And for conventional, it's 7 years. So those are very important when you're looking at a credit report, knowing what type of loan product you're going to put in. Hopefully that makes sense. If you guys have any questions in regards to credit is a huge indicator. I know when I pull a person's credit score, I have not just the credit score, I have to look at the trade. Those are the accounts that are open, charged off, collection. If something's in collection, we have to hit them for 5% of the balance. If it's charged off, we don't hit them for anything. It's bad debt, charged off. It does hurt their credit score, but we don't count it against them. Amex accounts, believe it or not, because those are paid off and paid in full every single month, whatever the balance is, we use 5%. I'm trying to think what else. Some other things. Oh, there's this is a really awesome thing. So if a person owes less than 10 payments on their auto loan, we can exclude it and not hit them for that payment. So typically what I'll see is if I see somebody that maybe has 11 months, and I'm like, oh, great, okay, you're getting ready to be in the exclusionary period where, we wait 1 more month to get you pre-qualified, we can actually exclude that payment. So $350 actually of a car payment can actually bump up their purchase, purchase or buying power. Okay, so that is credit in a nutshell. I'm going to go ahead and go to my next couple of slides. I'm going to just kind of step over here for a second, guys. And assets. Assets is huge. We have assets. Assets are basically bank statements, 401k, anything that's going to be considered liquid money, money that you can access right away. 401ks are not really considered liquid, so you actually have to withdraw those and put them into a liquid account, which is like a checking or savings account. Typically, savings must be documented. So we did mention something yesterday about seasoning and sourcing. So anytime people have large deposits, you can't use a loan to get a loan. I have a lot of people think that they can borrow their down payment. You can't use a loan to get a loan. So we can't rob Peter to pay Paul. That's what I usually tell people. You can't do it. You got to be able to get the money. If you're getting an inheritance, I've had clients buy their money with life insurance money or inheritance. We just have to be able to document whatever is going into that account that's outside of your normal paycheck or your normal earnings history. So basically, gift funds. Gift funds are something that a lot of people use. Sometimes grandma, grandpa, mom, dad, you know, instead of giving you a wedding, they say, I'm going to help you buy a house. I'm going to give you $50,000 to buy a house. They've signed a gift letter. They send the money to literally to escrow directly. And basically, it's allowed. Gift funds are allowed. And then 401k, like I stated, is basically you can use up to 50 to 60% of what's in that account. So if a person has 50,000, we can usually typically use about 25 to 30,000, just to kind of give you an idea. And we usually need the terms of withdrawal. We need to see all the paper trail from when you went and you requested it, filled out the paperwork, and then how it went into your liquid account, your checking or savings. And so normally when a person's saying they're using their 401k, I make them initiate that right away because sometimes that will take 2 to 3 weeks and we don't want this to hold up the transaction. Okay. All right, so AUS. Let's have a conversation about AUS. I brought that word up and I said a lot of these acronyms that I had, I brought them up because I wanted you guys to understand what they were. So we have 3 different systems that are used, okay? And I want you guys to understand what an automated underwriting system is that it's basically, we put all these data points. We put the income, we put the credit, we put the assets, and this is even prior to having a property. So we are basically predetermining if this borrower is eligible for a home. So we feed this automated underwriting system. It's kind of considered like a pre-underwrite. And basically what it is once we put all the right data points in it, we run it, and it either tells us that the borrower is approved, eligible, meaning they're good to go. Refer eligible means that's a manual. That means they're kind of good to go, but it's going to require a little bit more finessing from the underwriter and a more careful look. So manual underwrites are okay, but you got to make sure your borrower has all their ducks in a row because they have more layered risk is what we call them. That maybe they had a BK, maybe they had a past foreclosure. They're looked at on a manual as more of a higher risk. So if we get approved, then we know we're golden. And typically, sadly, in our market right now, most people want to see DU findings when you're submitting these offers. So DU is very important. When you hear the word DU, that's pretty much your AUS. That's your underwriting system, your automated underwriting system. So on DU, there's 3 different ones. We have DU, FHA, VA, and Fannie go underneath, and DU is typically the desktop underwriter and our loan system. And then LPA is we can use VA or Freddie, but LPA is more of a conventional. We do have VA loans that we can run with LPA. I've gotten good findings from that. And then GUS is its own entity and it's its own little animal, and it applies to USDA loans, which are loans in rural areas with acreage. So basically, this AUS is going to tell us winner, chicken dinner, or no, we got to work on some things. And sometimes if people have had challenges with paying their bills, if they've had challenges with foreclosures, or just maybe they just have too much debt, they have way less income and way too much debt. So it really is a huge indicator if we can move to go, is what I always say. We can move to go, or we're going to stay on start and keep working on some stuff. So this is really, as a realtor, it's really important that when you're working with your lender, I mean, hopefully it's me, but if it's not, it's a lender maybe that's coming, you're on the listing side, you need to make sure you understand your DU. And if you don't, you can always send it over to me. 9 times out of 10, you want this all the time. And even if it's a manual, we can still look at it and say, well, yeah, because there's certain criteria that falls underneath a manual underwrite. And that's stricter debt to income ratio, DTI. So basically on a manual underwrite, I'll put this over here, you would be capped at debt to income ratios. And we'll talk about this a little bit later, but usually they're maxed at like 31-43. That's pretty low considering most of them go up to about 50 to 56%. So you got a big difference in manual versus what these ones do. So you can go higher with your DU findings on a regular approved eligible, but when you're a manual, and it's a little kind of, I know it's probably like, what's a manual? It's just really making sure that this person is eligible because they've had issues in the past. We have to make sure that their credit works. That's really what we're looking for. Okay. All right. I'm going to move to the next one. We're just moving right along. Property.
Between that and the slides too. So.
No worries, no worries. Property condition, guys. Property condition is huge. As a realtor, you know, if you take a listing, you're going to have to walk a property. And this is very important when you're taking a listing, but also on the buyer's side, you got to walk the property. You know, things are going to come up on inspections. You usually have, you know, your home inspection. You sometimes on our VAs, we always have to get a termite inspection. So property conditions is huge. Certain things have to be in order. Like on VA and FHA, if there's chip paint or any kind of funky things like utilities not being on, appliances missing, wires hanging out, those are going to be red flags, and the appraiser is going to flag it and say, nope, we got to get this repaired before we can close this loan. So property conditions are huge. Basically, when a home inspector, we know that a home inspector, when they come to the property, they're working on behalf of the person buying the home. And they ultimately are hired to find everything wrong with the property. And usually agents, especially on the listing side, are like, oh, our home inspector was horrible. They found everything wrong. You know, this is ridiculous. But at the end of the day, as a buyer's agent, you are working for your buyer. And that person is working for they're a non-biased party working for your buyer. Some things will be cosmetic, but hell, they may find things like a roof, or they may find things like electrical. They're going to be able to be more familiar with what's going on with the house. We don't know that. We're not trained to do that. So property condition is huge. The biggest thing that I like to always point out is health and safety things. You know, wires, nails hanging out. You know, people will have junk in the backyard that's literally ready to tumble over. Clearing debris. I see that. I used to see that a lot on appraisals when I was an underwriter. Grow houses. That's a big thing right now. People are growing weed in garages. If you ever run into that, you guys have to make sure, because marijuana is not federally approved. It's an automatic hard stop. So if you ever run into somebody that's growing, you know, cannabis for their own use, hey, that's their prerogative. But if you enter under contract, just make sure all that stuff is gone before the appraisal gets done. So that's been a new thing that I've seen on a couple of properties. And so I just want to make sure you guys are aware of that. And then the property inspection waivers. Property inspection waivers, like I stated yesterday, they are the ability to be able to get your appraisal waived. Sometimes we're able to get those when we run DU. DU will come up and it'll say, property inspection waiver granted, no appraisals needed, which is a blessing, because not only is it going to save your borrower $500 to $600, but we have no issues of value not coming in. You know, maybe a person just recently bought the home and sold it, and their appraisal has already, or value has already been logged in the system. It's different components that give us a property inspection waiver, but believe it or not, we don't just get them on refinances, we get them actually on purchases sometimes. So I usually just tell my team, let's put in the address, let's run DU and see if we get a PIW first. And that's what the property inspection waiver is. So, and then ADUs. ADUs are huge. They don't necessarily have to be permitted, but they do have to be done in a workmanlike manner. Typically what happens is that you get a lot of garage conversions, and when you start getting into electrical and plumbing, that could be a little bit of an issue, especially if it was Jimmy rigged, or I call it ghetto rigged sometimes, where people would just come in and they just do it any kind of way. So it has to be done in a workmanlike manner, because at the end of the day, it's a health and safety issue. If that house was to catch fire, or that garage conversion or ADU was to catch fire, then it makes the lender responsible, the appraiser responsible, the agent. Now we have a big lawsuit because somebody's died in a house. Another thing that's huge is if you have bars on windows, they have to have by law safety quick release latches. And so that's another huge thing, especially in Los Angeles, San Diego, first places that are a little bit more urban. If you do ever take a listing, that's something to think about. And then also it's by law, we have to have a CO2, we have to have a smoke detector, and we have to have double straps on our water heaters. Those are things that would not allow us to pass inspection. So I always try to make sure that clients know, I always ask my agents, hey, we're under contract. Did you walk the property? Yes. When's our home inspection? Okay, awesome. Let me know before we get the home inspection back, or before I order the appraisal, because I usually order the appraisal right after home inspection is getting ready to be done. But if there's something that comes up on that home inspection, at least I'll have time to actually put it on hold. So we try to work together, because sometimes repairs, some funky things come out. If they're cosmetic, we keep it rolling. I'm going to be honest with you guys, conventional is a lot more lenient than FHA and VA. VA always works for the veterans, and they should, because I mean, hell, they fought for our damn country. That's the least they can do is protect what they're buying. So VA and FHA are a lot more strict on property inspections. And so anytime I have that type of loan, I always will say, you know what, I noticed something on the pictures on the MLS. I think we need to address this. Can you make sure X, Y, and Z is done? Make sure there's no chip paint. And I do my best to make sure I convey that right when we get under contract. Okay. And that's pretty much in a nutshell property conditions, but those are really important. It's a very important component as a realtor to work with your lender partner to understand what's the hard stops and what are going to cause delays. And these things cause delays. And right now, everybody's writing appraisal contingencies with none sometimes, or 10 days. So you want to make sure that we hit the ground running and you address any issues when you walk these properties, and you address them and you work together with the agents and all parties. Okay. All right, so I'm moving on to loan programs, and today we're going to cover, we're back on track now, awesome. So government loan program, which is huge. And I think I'm gonna go over here. So our government loan programs are FHA, VA, USDA. We're gonna start with FHA, okay? So FHA is basically insured by the Housing Administration, and it's an insured mortgage backed by the government, basically. So what that means is that if there is any kind of default or lack of performance on the loan, the lender actually has an insurable loan. As long as they follow the right criteria on the loan, they actually can get recoup some of the loss on the loan. Maybe all, maybe some, it just depends. But it's called a qualified mortgage loan is what it is. They follow certain components for it. So as long as they follow certain components, they're fine. So basically, FHA has some guidelines and some different things. I want to kind of highlight different things. Minimum FICO on FHA is 580. So it's kind of one of those type of homes or loans that can get a first-time borrower that has maybe credit challenges in a home. 580. Now, typically the down payment is 3.5%. And if a borrower has a 580, I'm going to be honest with you, they need to put down a little bit more. It's a little bit more of a riskier, non-performing FICO score is what we consider it. So if you have under a 620, you're considered non-performing, just to be completely honest with you. Recently, they just changed that 580. It used to be 550, but when COVID hit, they kind of tightened up on guidelines and said, we need to bump that up a little bit because people at 550 just were not performing. And so that's usually what they'll do when things like pandemics or different crises or different recessions are getting ready to come about. They will tweak and move up the required criteria to actually lend on FICO score. FHA is an owner occupancy loan only. So you have to live in the property for at least 1 year. And so I typically tell my first-time home buyers, if they're not coming by the way of the down payment assistance program, that FHA is a great way to get you in the home. You don't have to stay in the loan, but it's great because it has low interest rates and it has a low down payment requirement. And so basically, the only drawback that I really am not a fan of, and they just recently changed this, I believe it was in 2013, is FHA. There's something called mortgage insurance. FHA has lifetime MIP, mortgage insurance premium. And so it's for the life of the loan. And that tends to be a little challenging because what mortgage insurance is, guys, is it's not insurance for you. It's insurance if you default, and it basically is a pot that you're paying into. So if you default, the lender can go to that pot and use that for legal fees and home preservation and whatever else is tied to that default or that loss. So it really is protecting the lender. You're paying into a pot, and they make you pay an upfront mortgage insurance premium. And so sometimes that tends to be like $5,000, depending on the loan amount, it's like $5,000 to $10,000 that's financed into your loan. And so that's kind of the only drawback. So typically when I do put a lot of clients to this product, I typically tell them, we're using it to get you in the home. Ultimately, as you grow equity, we're going to switch you to a conventional, because conventional is not lifetime mortgage insurance. And we'll get into that tomorrow, and I'll explain the difference between the two, okay? Once again, the appraisal inspections tend to be a lot more strict. So if you have a property that has really thrashed, if the borrower can't be flipped conventional because they're a little bit more, or maybe even I'll do an FHA 203K. We'll talk about that. That's a rehab loan. Sometimes that's where it's not financeable, where we'll have to come in there and fix some things up to make it work. One thing about FHA is income stability is huge. Like if a borrower switches more than 3 jobs in 1 year, that's a red flag in FHA's eyes and their guidelines. And guidelines are basically the rules that we lend to. So they're like, there's these set rules for each entity that we put a person in, each loan program. So the guidelines tend to be very strict on FHA. They just have some really tough rules. They're also very strict on part-time income. It has to be 2 years, no interruptions. So they want to see a history of it if we're going to use the income. And there is no budging. It is 24 months to the date. I have tried. I've called the Homeownership Center at FHA. They're like, absolutely, 23 months does not work. It is, our guidelines say uninterrupted. So that's how they protected themselves. OT and bonus, we're going to use it. Like I stated yesterday, it has to be a 2-year history of it, because it's considered additional income. Any kind of variable income, it all has to make sense. Commission employees, they have to have 2 years. If a person's commission, like I get a lot of car salesmen, and they're newly car salesmen, and I'm like, you haven't earned the commission for 2 years, so we're gonna have to wait if we're gonna go FHA. It's very strict because that's variable income. That income is up and down. It's like a realtor or lender's income. Sometimes it's good. When the getting is good, it's good. When it's bad, it's bad. Another thing on FHA that's huge, because we are a community property state, like many other states, meaning what's his is, what's yours is yours. What's yours is mine, and what's mine is yours. So if you ever divorce, 50-50 state. Here in California, we have non-borrowing spouses, meaning people that are not going to be on the loan, but maybe I'm going to buy an FHA home and my husband's not going to be on the loan. I still have to consider his debts. So that's a huge thing. When I'm structuring a person and they're married, the first thing I say is, how's your wife's credit? How's your husband's credit? And they're like, oh, they have $200,000 in student loans. And I'm like, ooh, okay. All right, we'll figure that out. And sometimes it will disqualify someone because their spouse has too much debt. So that's another kind of kicker. The cool part about FHA though is that they do allow us to have a high DTI. Your debt to income ratio is one of the highest, like VA. So you can go up to 56.99. That's pretty damn high. That's like damn near almost 60% of your income that you can use to qualify for this loan. So that's an awesome thing. And then the AUS, they use DU, manual or standard AUS, which is the underwriting system. And then another thing on FHA for the student loans, back a couple years back, they didn't hit you for student loans that were in forbearance or deferment, but now they do. They hit you for 1% of the balance or the fully amortized payment, whichever is lower. And so that sometimes will throw a lot of my doctors, lawyers, nurses that have, $150,000. Maybe they're in some, income-based repayment plan. That really hurts them sometimes. So if I do have a person with a lot of loans and they're in an income-based repayment plan, sometimes I won't put them in FHA. I'll actually try to figure out a way to make them conventional. And we'll talk about that a little bit tomorrow. But that's FHA in a nutshell. I don't know if you guys have any questions. That kind of just highlights some of the things that they do. But FHA is really typically, guys, it's used for a first-time home buyer, maybe doesn't have that great a FICO score, or maybe they do, but maybe they don't have a good enough down payment. One thing about FHA that's really cool, they have awesome interest rates. And I, as a lender, get to come in. So oftentimes when I have a person and they have maybe $18,000 and they need $10,500 to get into their home, and I know really 18 grand is all they have. I don't preach broke home ownership. I preach keeping you in a home. And so I always tell my clients, I will help you cover your closing costs, because of course in this market, we can't ask for any type of seller concessions. Sellers, that this is a turnoff. So what I typically will do is cover most of the 2.5%. Usually closing costs are about 2.5% of the purchase price. So I usually will come in and try to at least cover that for my clients as a lender. And clients don't forget that. And it's also something that helps them know, oh my gosh, she didn't put me in a home and be broke, because now they're no longer any landlord. They are the landlord. So that's FHA in a nutshell. Okay. All right, we're going to move on to VA, one of my favorites. So VA is basically a loan that's guaranteed by the Department of Veteran Affairs. And so it is for active duty and retired, or, you know, people that have been discharged from the military in some form, whatever chapter. So, or not chapter, what do you guys call it? Is it unit? Not chapter, division? I don't know. I'm transition. Okay, awesome. Yeah, discharge, exactly. So basically, VA is another awesome tool. I love to use this. Sadly, a lot of people don't use their VA, and that's what I get when I do consultations. I always ask, are you retired from military? Are you military? Retired military? Active? No. Okay. All right. Is your husband? You know, so I really try to pull that out of my clients, because you'd be surprised. There's so many people that don't realize that it's really not one of the easiest loans to do. So minimum FICO is 580. 100% financing. I absolutely love the fact that it is 100% financing. There is a caveat to that, and I'll get into that in just a second. Lower interest rates. They too have a tendency to have very good interest rates for our veterans. And so, and then it's for active duty and veterans, like I stated. There's no mortgage insurance or PMI, yay! So that's a blessing. That really drives our payment and sometimes takes people out of the qualification realm that they want to be in. Sellers or lenders can cover any non-recurring closing costs. So the funding fee sometimes tends to, you know, if the person that's on the loan is not fully disabled, their funding fee cannot be waived, or they're not partially disabled. So that's where some of the non-recurring closing costs will come from. And so I typically, nine times out of 10, as much as I can cover, I have one that just went under contract yesterday. That's a VA loan, and I'm covering all of his closing costs. And the other lender, he broke up with the lender because the lender was trying to push the 6,000 somewhere in North Carolina. But, you know, it's the least you can do. Come on, the guy served his damn country. So typically on our max DTI, believe it or not, guys, it's typically 52%. But I've gotten DU to go up to 60, believe it or not. So VA does have a 52 to 60. That's, of course, the layered risks are good, meaning that the buyer just has some awesome credit profile, low debt to well, I shouldn't say low debt to income ratio, maybe some reserves in the bank. Maybe they've been on their job for a long time. There's just a really, really good profile where DU really likes it, okay? And of course, we can do D or LPA on that one. So we have these two products for our AUS. The appraisal inspections tend to be stricter as well because they're trying to protect the veterans. I had a veteran that literally some chip paint on a deck, and the appraiser called it out. But I mean, at least he called it out, and they had to remdify it. It was like, and they gave the cost to cure. That's basically the cost of what it is to make it better, and it was $200. So I'm like, okay, got with both the agents. Hey, we're good. Appraisal value came in, but we got some chip paint. We talked about this at the beginning of the transaction when I introduced myself to both sides and said, hey, okay, these are the things we're going to look for. You said everything was handled, and it wasn't. So we need to get this remdified. I got to order my reinspection report. So basically, I really do love the VA loans. I feel like they're very underutilized. I feel like there's a lot of discriminatory things that go on, and you will realize that with realtors, people tend to stray away from VA and FHA because of appraisal inspections and the stricter guidelines. But it really is an awesome loan, and I challenge every realtor that is in our community to make sure that you are asking and leveraging this and encourage our clients. If they are a veteran or active duty, they need to be utilizing their benefits. This is a benefit. They don't get much, so they should be utilizing them for sure. Okay. The next one is USDA. Not a very commonly used one, but believe it or not, guys, in this area, right outside of our community, we have a lot of rural area, underdeveloped area. There's some little spigots that you would be so surprised that would qualify for a USDA loan. So USDA is backed by the U.S. Rural Department, and it's basically a guaranteed housing program. It's considered an agricultural loan. So it's going to be more in that area. People think of agriculture of like farming area, but it's really just land. Anything that's, 5-10 acres, that would be considered. And they have an ability to be able to actually look up an address to see if it's a USDA qualified. So let's talk about USDA. So USDA is a little bit more, it does have a little bit more layers to this loan, and it's a little bit more stricter as far as debt to income ratio. They like to have certain things, even income, depending on what the income is. So it is minimum FICO of 640. This is another 100% financing loan. They typically have lower interest rates. You have to find the homes that are located in the rural areas. So they do have an address lookup. You go to their address lookup. So typically when I have a client that says, I want a house with 5 acres, I'm like, okay, awesome. Have you considered a USDA loan? No, well, what is that? I go into detail. Basically, it's a loan. It's 100% financing. It gives you the ability to buy in areas that are considered more rural. So I always throw that out there. I don't always just assume when a person, when I do an intake, I really try to figure out what they're trying to accomplish. Well, what are you trying to do? Are you trying to buy a condo? Or everybody has different needs. No, I have horses and I want to buy land for them. I'm tired of storing them at my friend's farm. Whatever the case may be, when I hear people say land or space, or because they need space for storage, I always think, okay, well, have you ever considered USDA? Most people have never heard of it. They're like, what is USDA? What, the milk people? It's like, no, it's not the milk people. It's a product that is considered for rural areas. And so it's a really good product. It does have similar, it does have mortgage insurance, but it's called a guarantee fee. It's a small guarantee fee that's charged throughout the life of the loan. The cool part about the guarantee, though, is it does get better throughout the life of the loan. So it does kind of decrease as the time goes on. And inspection areas in this particular like loan and the areas that these houses are located, they're usually in like fire areas. So that's the only thing that usually is like noted. Homeowners insurance tends to be a lot higher because you're in those rural areas, and usually 9 times out of 10 they always come out of fire area. This is huge, guys. DTI is capped. The DTI on this one is really low. So on a standard loan, it is $29.41. Now, if you go manual, it actually goes down. It goes. I'm sorry, manual is $29.41. If you go on a standard loan, it's $32.44. So it's a little bit. What I normally will make sure when I'm pre-qualifying someone, I will sometimes make them pay off debt to qualify if they really want farm, rural area, and I know that their debt to income ratio is going to be really high. I make them pay off debt. So, and then they run GUS. So GUS is the underwriting system that they basically run on for their underwriting system. And that's pretty much, USDA is a very good loan. It's a little bit more of a difficult process. And so basically, I never just assume that people don't want it. I do give the options, and I'm one of those make sense lenders. I look at all options. I don't make a decision for the clients. I inform them so we can make the decision together. What's the benefits of each product? And I'm going to do what fits their needs and what they're trying to accomplish at that time. Okay. So that was the conclusion. I'm actually done. I jammed through it because I wanted to keep this as quick and as informative as possible. This is going to be a slideshow that's provided to you guys as well, so that you guys have it as a reference tool. I always like to conclude our day with questions or concerns. Any kind of comments that you have? Anybody have any questions?
I'm watching. It sounds good. Info is awesome. Easy to follow. Love it. This lady is wonderful, A to Z. Incredible. She's moving. Keeps your attention. We like it. No questions from Facebook?
Any aha moments? Yes.
At what point can somebody use FHA again?
That's a good question. So there's certain rules to FHA. So if a person is moving, so typically you can't have 2 FHA loans, but the only time that you can, say for instance, you're going to relocate and you have an FHA property and maybe you got relocated from, you know, San Diego to North Carolina and you want to do the FHA again. Well, as long as we can document that it's a legitimate relocation and you just basically, okay, awesome. And so that's one way. Sometimes you'll have parents that will co-sign for their kids. So that sometimes is, you know, one of those things where it's like, oh, well, I co-signed for my kid. I don't live there. We prove that, oh yeah, they indeed co-signed. They're getting their own home now under FHA. There are strict rules with FHA because it really is only an owner occupied. When I do run across clients that want to keep their home, maybe they want to rent it out, but it's FHA. The first thing I say, you need to refinance that into conventional if you want to use the FHA product. I get a lot of clients that maybe will want to go and help their kids and they're saying, oh, I'm going to help my kid buy a 4 unit, but they want to do it on FHA because they want to exercise the 3.5%. So it just depends, you know, but there's some very strict rules. And the thing is a lot of clients last year refi FHA Streamline, which is just basically like a really seamless refi, no doc refi. When you hear Streamline, they have the Earls and then they have the FHA Streamline. So that's just basically you're reducing the rate, the term. It's pretty much a no doc loan unless you're deleting a borrower. But then the other borrower that you're deleting goes off and they have to prove that they can pay for the property by themselves without that other person. But if a person does a Streamline and then turns around and says, okay, in 6 months, I want to go buy another house. Well, FHA, it has that 1-year rule. That's a huge red flag to a lender. So I always ask people when I'm doing my intake, what's your intentions? Do you intend to stay here for a long time? Or do you intend to leave in the coming months or year? Because that is a huge, people literally shoot themselves in the foot just trying to save money when it's like, that wasn't a smart move. Now you could get in trouble for occupancy fraud. So you have to be careful with certain things. So I always try to think when I do the intake, you have to listen to your client. And as realtors, the same thing. Listen to what they're trying to accomplish. You take your notes, and then that's when you know how you can serve them and you can help them. That's really what it boils down to. So, but that's pretty much in a nutshell. That's it.
This is wonderful. A lot of great content. I've learned a couple of things today, and so you know, the 203K was awesome. I had no idea.
I'm going to talk about it a little bit more on Thursday.
Okay,
Yeah,
perfect.
yeah.
And then I know we can go deep as far as VA and all the options within VA. So if you guys have more questions about VA, of course, we specialize here at our community with the VA loan. We are a team of veterans. So there are options within that VA home loan. If you're looking for land, if you're looking to remodel, if you're looking for condo,
yeah, and VA goes up to down near $1 million. It's like there's no limit. There's no cap anymore. Yeah. You can get whatever you qualify for. You can. I love when they did that last year.
I know, that was so huge.
Well, I mean, come on now. They think they want to put you in a box.
Yeah, there's a lot of big wins for veterans with the VA loan in 2020. Absolutely. And of course, we can dive deeper on that on another day.
Oh yeah, for sure.
Lord knows we talk all day about the VA loan. But thank you guys for tuning in today. Thank you, Ms. Sarah Jackson, for all of your knowledge. Oh, absolutely incredible class today. So we're going to wrap it up here. And of course, we've got our monthly meeting kicking off at 11 o'clock with all of our local small businesses, nonprofits, vendors, and anyone in the local area. Please come out and see us at 11 o'clock at our community. And thanks for tuning in today, guys.
Awesome. Thank you, guys. Have a good day.